Hey everyone, and welcome to the Ncast. I'm Guy Weissmantel, your host and Executive Vice President of Marketing here at Ncontracts. In this podcast, our subject matter experts from across the company will be talking with industry thought leaders about relevant topics and trends in compliance and risk management for financial institutions. You'll learn the latest tips and tools to manage risk in this ever-changing environment. Let's get started.
Hi, and welcome to this episode of the Ncast. My name is Paul Vinecourt, and I'm a solutions architect here with Ncontracts. Today, we're going to be talking with Greyson Tuck, an attorney for Gerrish Tuck Smith Consultants and Attorneys. Greyson's specialty is in banking, corporate finance, and securities law. And today, we're going to be talking a little bit about community banking and some of what we're seeing is the future and some of the strategy around that. And maybe we'll talk a little bit about some compliance and risk issues in the community bank space if we've got some time. But, I think one of the interesting things about you, Greyson, that I kind of wanted to convey to our audience right off the bat here is, you have an interest in community banking. So can you give me a little bit of a description of what drew you to this area of specialization in your advisory and consulting practice?
Yeah, absolutely, Paul. Thank you. And it's a little bit of a mixture between both personal and professional. From a personal perspective, I am the proud son of a community banker. I remember in the mid 1990s, my dad left a large regional bank at that time and went and with a group of organizers over in East Tennessee, started a community bank. So personally, I've seen community banking for a long time, but professionally, I've got an accounting and finance background. I went to law school and knew that I wanted to do something corporate, wanted to do something not in the courtroom, but on the business side. And it just so happened that this firm here in Memphis was looking to hire about 14 years ago. And luck would have it that I came on and have been practicing this type of law for about 14 years now.
All right. Yeah, it's interesting how the community banking kind of gets in your blood, and next thing you know, you've made a career out of it. And it also sounds like it's in your family too as well. So very interesting. So I've seen you speak a couple of times at some different engagements, and we seem to focus a lot on strategy. So I wanted to kind of have a conversation around some of the things that you might foresee strategically for community bankers, kind of in the short and longer term. So I think we can start off with kind of that general question of, what do you see as the future of community banking? And really, what significant developments do you foresee over the next couple of decades?
In terms of the future of community banking, I will say two things. Number one, I think it's bright and I think it's available. There are many people out there that say, community banking is dead. There is no future in community banking. Community banks are, walking zombies. And I don't agree with that. I believe that there is absolutely a place for community banks in the future, both, whether that's 5 years, 10 years, 30 years from now. But I think it will be different. And those community banks that are able to capitalize are those that are able to really actively pursue relevance. I think really what's been interesting, and the pandemic has changed so many things, but the pandemic really has heightened the focus on community banks being relevant. And what is it that community banks need to do to maintain relevance to their stakeholders? And when we talk about the stakeholders, I think we're certainly talking about the stockholders. We're talking about the employees. We're talking about the customers. We're talking about the community. So they're really, I think, in terms of the future of the industry, it's there for the taking. I don't believe that there's ever going to be a change in the need for the fundamental services that community banks provide. I think that there will always be a need in America for a safe repository of cash. I think there will also fundamentally be a need in America for credit. And community banks are well positioned to serve both of those needs. The delivery channels through which they do so will be different. And those community banks that survive and thrive in the future are really those, I think, that will be thought leaders and industry leaders in how it is that those products and services are delivered.
I couldn't agree more. Obviously, I share your viewpoint as far as the importance of community banking. But I think the thing that you said, the one word was fundamentals, right? Community banks are kind of they have that cornerstone in the fundamentals that are so important for the local community. And then really when I look at that landscape of, across the industry, there's that natural ebb and flow of de novo and then acquisition. And it seems as though obviously the de novo stopped in 2007 for quite a period of time, but we're starting to see that pendulum swing again. And so hopefully we'll get a new influx of community banks that will be founded upon being relevant and having those fundamentals. But speaking of fundamentals, one of the things that you also mentioned is staying relevant as well. So I'm a big a proponent of fintechs, right? I do a lot of research on and pay a lot of attention to fintechs and how they interact with our industry and especially community banks. So, question for you is, what do you see? What role do you see fintechs playing in the long term? And then also, do we view this as a symbiotic relationship with community banks, or is it an adversarial one?
Well, I think let me maybe answer the second question first in a little bit of a provocative way by saying I think it's a little bit of both. I think that community banks will certainly have fintech partners and community banks will have fintech competitors. And that's not altogether different from other community banks. In terms of the role that I see fintech companies playing, the idea of a fintech company, that's a pretty wide encompassing term. But when I think about fintech companies, I really think of two. I think of customer facing fintech companies, things like your Chime, your SoFi, your Lending Club, that are what I consider in the shadow banking industry or in the not as highly regulated banking industry, that are customer facing, that are providing customer products and services. And I think for community bank, largely those will be competitors. When you look at what Lending Club is doing in terms of looking to provide or pair individuals that want to extend credit with individuals that need credit, that's not altogether different from what a bank is that a community bank's providing. But then I also think there are back office fintech companies that really are not forward facing in terms of the public at large as customers, but are instead really looking to be service providers and partners with fintech or with community banks, excuse me. So, when we look at those, I think we've got both. And then I think you'll have some crossover. There will probably be some, service providers to community banks that are also looking to provide some services to the public. And then you'll probably have some that are primarily provided to the public, but may offer partnership opportunities, whether that be, loan participations, deposit gathering, whatever it may be for community banks. So I think that's still a little bit to be determined, but I don't think there's one box in which we could fit the entirety of the fintech companies and how their relationship is going to occur with community banks.
Excellent point. And, that definition of fintech has kind of changed over the course of time here. And so what we used to think of and lump into one big bucket as a fintech is now more to your point. The client facing folks are fintech. The back office folks, such as Ncontracts, are more of a reg tech, right? So we're starting to see the splintering of what a fintech really means into, is it customer facing? Is it not? What type of service it provides? So yeah, excellent advice there as far as segregating out what's customer facing and what's not. And as well as what's going to be a competitor versus an ally. But getting a little bit away from fintechs, but staying in the strategic realm, aside from those fintech or reg tech partnerships, what do you think are the best and most appropriate IT or cyber investments for community banks to be making, both in the short term and in the long term?
Well, I don't mean to be flippant in the response here, but I think the best and most appropriate IT investments are those that customers need that provide the highest return on investment. And let me kind of explain that and unpack that a little bit. Here's what I mean. One of the struggles that I see with community banks today, I get the opportunity to do a number of different things with community banks, but one of those is facilitate strategic planning sessions. And when we get in these strategic planning sessions, many community banks are frankly perplexed at how it is that you evaluate a technological investment, right? The board basically says, look, somebody, a salesperson comes in and says, we need this. Of course, they're trying to sell their product, but we don't really know if we need it because we don't know enough about the technology. We don't know how to measure the return on investment. We're at a loss, right? And many boards feel that way. And so in terms of where should community banks invest their limited resources in technology, I think the best advice that I'm able to give is to do two things. Number one, separate the wheat from the chaff. Figure out what it is that your customers really need, whether that be, externally customer facing or internally within the bank, but what are the products and services that we really need to offer? And then number two, what is the best way to offer that product and service at the most appropriate price? Because we don't have an unlimited pool of resources as a community bank. So I think it's our job, or really the directors and officers' job, to really decipher that and ask those two questions to figure out what do we need to provide to our customers and what's the most cost-effective way to do that. Because, we can't be all things to all people, but we also can't be operating our business in a way that is just completely anti-competitive, right? Or that, is very detrimental to us. So it's a little bit of that balancing between, what do we need, what can we afford, and how do we allocate those resources to their highest and best use?
Yeah, and a lot of local benchmarking comes into play as well when you're trying to decide that how you're going to price things. We've got to look at across the competitive landscape and really look at how that works for our competitors as well. I think that's one of the things I've noticed in the smaller community banks is we really want to be customer friendly and just give everything away. And unfortunately, that's not always the greatest idea. And like you said, you have to really temper that new product or new service with what's the ROI and how do we make that beneficial for the client and ourselves. Getting a little bit more into the strategic planning thing, or the strategic planning aspect of things, in addition to the cyber discussion that we have, when you're talking to banks about strategic planning, is there one piece of advice that you'd want to give all community bankers that you're seeing kind of, a lot of when you're out there talking to folks?
Yeah, my fundamental advice is to understand your fundamental duty as a director or executive officer, and that is to enhance shareholder value. We can talk about a lot of different things about community banking and the future of community banking, et cetera, but ultimately the decision maker for the continued independence of your bank, the relevance of your bank is, in my opinion, most importantly, your stockholders, right? Because, if the bank's going to be sold, the stockholders have to approve that. If we fail to enhance shareholder value, then our stockholders may demand a sale. Because here's the way that I look at this, the stockholders have made an investment in the bank. That's one of literally millions of investment alternatives that are out there. And so the job of the community bank is to make that investment such that the stockholder deems it a worthy investment to continue. And so I kind of laugh sometimes. I know this idea of enhancing shareholder value sounds very consultant-ish. And I think a proper question is, what really does it mean when we talk about enhancing shareholder value? And I think it means five things. And so when we talk about really the fundamental duty of community banks, I think it's to grow earnings per share because earnings drive value. It's to provide an appropriate return on equity, balancing our capital preservation with our earnings, providing liquidity in the stock, which is the ability of the shareholder to convert their shares to cash at a fair price in a timely manner, providing dividends as a C corporation or dividend equivalent distributions as an S corporation, and maintaining regulatory safety and soundness. I think if we do those five things and we continue to do those five things, we've earned our right to do whatever it is that we want to do as an organization. But if we begin to get deficient in any of those areas, our ability to continue our independence is threatened.
Wow. I really like how we boiled that down to five things. If all of our boards could do that, we'd have much shorter meetings, right? But again, those, to get to those five components takes a lot of other work behind the scenes. But I really like the fact that we can boil things down and focus on, five really fundamental characteristics of that shareholder value. Because you're right, we talk about shareholder and stakeholder value all the time. And that means something different if you're an auditor or a risk practitioner or a compliance person, as opposed to being a lender or a C-suite member. It means different things to different folks. So I like the fact that you can succinctly define that and then talk about that at the board level. I think that's a really great thing to be able to do.
I tell boards a lot of times that if we're doing those 5 things well, it's hard to criticize us. I mean, where are the chinks in your armor if we look at each one of those 5 subcomponents and we have a history of performance, we have current performance, we have a plan for continued performance. Yeah, I think it's pretty tough to criticize that.
Absolutely correct. Yeah, well, especially one of the components is keeping regulators happy. So I think
Sure.
we're good there too. I know you talked a little bit about staying relevant. I know we talked about the fundamentals, but I'm kind of wondering if you have some additional comments on staying relevant in the future, right? So when I look at it, we talk about that Main Street USA model of community banks, and so I'm kind of curious, can community banks keep that Main Street USA model and still be relevant in the local community? Or if they if they want to stick to that Main Street USA model, will the ultimate survival be based on their ability to adapt to changes in the market and customer demand? So, how do we counterbalance what our customers are used to seeing from us as community bankers versus the shift in demand for the new customer?
Yeah, I wish I had thought of this. There was a quote that I read a couple of years ago, and I haven't been able to put my hands on it since, but the quote stuck with me, or the central idea of the quote stuck with me. And that is this, that technology has eroded the protective moat that geography once provided to community banking. And the idea is that, 20 years ago, community banks had a very captive audience, right? There was only so far that you could go. You couldn't pick out, a phone out of your pocket and cash a check. You couldn't go online and receive credit. And so, physical location was a limitation on the ability to engage in financial services, engage in your banking. Well, that's significantly different today. We could have a nationwide bank that does not have a nationwide branch network. And because of that fundamental shift, I think community banks need to be forward thinking in how it is that they're going to react to that fundamental shift. And my belief is that, particularly in the future of community banking, the idea of community will not be defined by geography. I don't think that community banks will live and die or thrive on their local markets. I think the well-run community bank of the future will look to a different type of community. And what I mean by that is I think there will be a shift away from geography, and I think there will be a shift to common bonds. And I know that's always kind of a dangerous word in the community banking industry, because I'm not talking about credit union common bonds. But what I mean is that I think community banks will become focused more on interest or particular ideas of their customer base rather than geography. An example, there are a couple examples of this. There's a de novo bank right now that's coming online in Florida, Climate First Bank. They're going to be a bank that is centrally focused on supporting companies that are looking to engage in climate responsible practices. There's a bank out there called Esquire Bank. This bank is really a bank that serves the needs of law firms. And so I think what will happen is the community banks of the future will be different in that it won't be necessarily geography based, but I think their niche or their community will be more widespread, but it will involve the collective central ideas, whether that be, I love to hunt. And so maybe, there's a bank out there that's focused to or caters to the needs of hunters. Maybe there's a bank that caters to the needs of musicians. Maybe there's a bank that caters to whatever it may be. But really what I view that as a significant opportunity for the bank, because we don't have to rely on geography for our sole market and our sole, customer collection efforts. Instead, we can cast a much wider net. So, maybe I'm right, maybe I'm wrong on that thought, but that's where I think things certainly are trending.
And it's a very interesting paradigm shift away from, again, this moat of demographic, or the moat of location, into this model of maybe we're going to do things based more on the demographics of our clientele, whether that's lawyers, musicians, or whatever have you. So that's that's a very interesting take on it. And again, since you brought up credit unions, we'll go there, right? That's a model that has been working for them, for quite some time. And so it'll be interesting to see if community banks will adopt that paradigm shift, or are they going to go against the grain and say, no, we're geography based and we're going to try to stay relevant within that geography. So, but as you mentioned, that may very well affect their ability to stay relevant and stay competitive. And so, time will tell the story there.
Sure.
But I know, we've done a lot of talking about, strategy and those types of things, but I wanted to also have a little bit of a talk about the risk side of things. So we had a couple of questions kind of on the risk side. And I'd like to get your opinion as an attorney. What are you predicting for the future of government regulation for banks and fintechs?
Well, I don't think it's going to get any lighter. I can tell you that much. I don't believe that in the near term or on an ongoing basis that you're likely to see any significant amount of deregulation. What I anticipate is likely going to happen. I'm really one of these believers that when something gets big enough, government will get its hands in it, right, wrong, or indifferent. But I do think that what you will see is I think you will see the shadow banking system. Many of these banks, or excuse me, fintech companies that are operating outside the current charter framework, whether that be a national bank, state bank, that are subject to the various regulatory authorities. I believe that government is eventually going to step in and going to create, particularly for those public-facing companies, the one we talked about earlier, that are really looking to provide products and services, financial products and services to the public. I think you're going to see regulation there. I don't believe that you're going to get, as that industry, that segment of the industry continues to grow, I don't think that you're going to continue to have banks, whether it be community banks or national banks, that are subject to regulation and oversight by the various regulatory agencies, but fintech companies that are providing essentially the same products and services in a way that is unregulated, or that has a significantly less amount of regulation than the banks do. I think there is going to be a leveling of the playing field there.
Yeah, and honestly, oddly enough, that I had a follow-up question, which you kind of already nailed there. But it seems as though we've been regulatorily have been trying to kind of close that gap and level the playing field, because really, when we look at the competitive environment, that disparity that exists between the shadow banks and the financial institutions doesn't create it creates a disparity in the competitive environment. So as a banker, we'd sure like to see an even playing field for that.
Oh yeah, absolutely. I mean, if and that's the whole frustration of the banking industry, is that there are many banks that just believe that the regulators really hamstring their efforts to provide products and services, and that their competitors, not other banks, but the financial services companies that are operating out there in the unregulated environment that are providing the same products and services, they don't have that same level of regulation. And so, I know certainly a lot of the banking trade groups are working on that. I fully expect that there will be fintech trade groups that push against it, because it is a competitive advantage for their organizations. And of course, they want to remain in that position. But I do believe that with time and continued proliferation of fintech companies, quote unquote, that I think that you're going to see government establish some more regulatory framework around those companies.
And again, I think an even playing field there is just going to support and promote competition, which is ultimately good for the consumer as well.
Sure, absolutely.
You mentioned earlier, you talked a little bit about climate change. So I want to kind of unpack that a little bit here. We've been hearing from regulators over the past couple months, including Janet Yellen at the Fed, about climate risk, and that they might be required risk consideration for larger firms. But I kind of wonder, how this would affect smaller community institutions. If there is a regulatory requirement, to assess and report on geographical or climate risks to your business, does that disproportionately affect smaller institutions and less than larger institutions? And I kind of would also like to get your opinion on, generally, how do we as community banks deal with the emergence of climate-related risk?
Yeah, well, let me answer the first question first. And the concern of community banks has been and will continue to be that what become requirements or regulation for the largest banks become, quote, best practices for community banks.
Mm-hmm.
You know, that really what you've got is a on-site examination team that says, you know, that this is what I call the yes, but examination, that, you know, when they raise something and the answer is, well, as a community bank, that regulation is not applicable to us. And the examiner answers, yes, but. Yes, but we think it is something that you should be considering as part of, and the regulators can always say safety and soundness. And how do you argue against that?
Mm-hmm.
And so, you know, do the community banks need to be paying attention to this issue? Absolutely. I think they do, because if there is, you know, specific regulation that comes out that is applicable to these larger banks, I do anticipate there will be some, you know, what I basically best practices regulation that will trickle down to the community banks, and the regulators will have certain expectations of those community banks as it relates to the examination practice. So, you know, I think it is important. What should community banks be thinking about? Well, I mentioned to you earlier that I think fundamentally our job is to enhance shareholder value. Two components of that were both earnings and maintenance of satisfactory regulatory relations. If we don't properly manage climate risk, I think those two items in particular, and then earnings would certainly feed into appropriate return on equity, are jeopardized. You know, if we're out there making loans or engaging, you know, a little bit less so in deposit relationships, but certainly as loans, where climate change is a fundamental risk of that credit, but we don't properly understand, we don't properly account for, and most importantly, we don't properly mitigate that risk, then we have risk exposure, right? And we mentioned earlier, you know, the fundamental job in banking is risk management. And so I think it's very important that we give consideration. You know, community banks can't just say, oh, climate change, you know, that's a big picture issue, that doesn't matter to me, et cetera. Because even on the micro level, climate change could certainly affect an industry, could certainly affect a borrower. And if that flows back to the bank's earnings, flows back to the bank's asset quality, that has a direct impact on the bank. So, you know, I think it's important that community bankers be thinking about that. But it's not just climate risk or climate change. You know, there are multiple risks that community banks need to be thinking about. And, you know, again, it's all about a great community bank is one that identifies risk, accounts for that risk, and properly manages that risk.
Yeah, and you know, the interesting thing is, as we talked earlier about, you know, staying relevant as a community bank, you mentioned, you know, shifting away from geography and into demographic-based banking. I think that would also really help kind of ameliorate some of those climate risks when you have a bank that has a more diverse population of clients than just, you know, those folks that are within the, you know, the 5 or 10 miles near their physical footprint.
Oh yeah, absolutely. I mean, you think about if we're a community bank and we've got, you know, 90% of our loans, 90% of our assets in, you know, South Florida, for example, and, you know, sea levels rise and there's a fundamental change in, you know, Miami and the surrounding areas, that could be a big deal. You know, that could be a real big deal. And so, yeah, I think absolutely the ability to diversify, whether we diversify our portfolio, diversify our geography, whatever it may be, that's absolutely an appropriate risk mitigation strategy.
Well, hey, Greyson, I really appreciate your time today. And thanks for participating in our Ncast. I think we're out of time for now. But again, I really do appreciate it. And so thanks so much.
Well, thank you very much for the opportunity. Enjoyed the discussion.
Hey everyone, that wraps up another great episode of the Ncast, where we are able to talk with people on the front lines of risk and compliance across the financial services industry. If you liked what you heard, please leave us a review. And if you're not subscribed yet, we invite you to do so on your favorite podcast platform. Thank you so much for listening, and we'll see you soon.